A major U.S. bank is already insolvent, not in theory, not in a stress test, on paper, quietly. At 11:42 p.m. Eastern Time on Tuesday, January 13th, 2026, while most people were asleep, a regulatory filing hit the FDIC database. No press release, no alert, no breaking news banner. But inside that filing was a number that should have triggered emergency meetings across the banking system. Here's the contradiction. The bank is still operating, deposits are still open, branches are still lit. But buried on page 212 of its quarterly call report in a section labeled Schedule RCM Part 2, the bank disclosed $17.3 billion in unrealized losses. Fact, this is a $91 billion regional bank based in Charlotte, North Carolina, with only $9.8 billion in total equity capital. Inference, that math doesn't describe stress. It describes negative net worth. Now notice what didn't happen next. Regulators didn't step in, trading didn't halt, your banker didn't call, and that's because current accounting rules allow banks to pretend these losses don't exist as long as they don't sell the assets. On paper, the bank is fine. In reality, it's underwater. This is where the story flips, because this isn't about one bank. It's about a system that's been quietly carrying losses for 3 years, accelerating over the last 12 months, and is now crossing a line where denial stops working. And here's why this matters to you. You don't need to own bank stocks. You don't need to work on Wall Street. If you have money in a bank, if you run a business, if you rely on payroll clearing on time, you're downstream from this moment. The dangerous part isn't the loss itself. It's what happens when confidence meets speed. In 2008, collapse moved slowly. You had weeks, sometimes months. Today, deposits move at the speed of an app tap. And once people start asking a single question, is my bank next? The answers stop mattering. What happened Tuesday night in Charlotte wasn't a warning. It was a signal that something has already broken. And once you see how this one filing connects to everything else sitting on bank balance sheets right now, the $8.5 trillion number stops sounding dramatic and starts sounding mechanical. So the real question isn't whether this spreads, it's how fast. What makes this filing dangerous isn't just the number, it's where it sits in a much larger pattern. Because this didn't begin in Charlotte and it didn't begin this week. Fact, the content traces this back to March 10th, 2023, when Silicon Valley Bank failed after realizing losses on securities bought when rates were near zero. 2 days later, Signature Bank failed. Those weren't bad loans. They were good assets bought at the wrong time, crushed by the fastest rate hiking cycle in 40 years. Here's the frame most people miss. That crisis was treated like a contained accident, a tech bank problem, a niche depositor base. But notice what was quietly normalized right after. Banks were allowed to park massive losses in a category called held to maturity, meaning the losses were real but invisible. Fact, as of September 30th, 2025, U.S. banks were carrying $620 billion in unrealized losses on securities alone. No headlines, no panic, just patience. Now here's the part nobody is saying out loud. Securities losses were the easy version of this problem. Bonds still pay, they still mature. Commercial real estate doesn't. And according to the content, this is where the system shifts from fragile to unstable. Fact, U.S. banks are holding about $3 trillion in commercial real estate loans, including roughly $626 billion tied to office buildings. And according to cited analysis, 44% of those office loans are already underwater. So ask yourself this question because it reframes everything. If losses that might never be realized were enough to kill banks in 2023, what happens when losses are permanent, when borrowers stop paying, when buildings are worth half the loan, when there's no buyer at the end? This is where the story flips from rate cycle damage to something structural. And the timing matters. Fact. Between March and December of 2026, $936 billion in commercial real estate loans are scheduled to mature. That's not a forecast, that's a calendar. Loans written at 1% to 3% are about to face today's rates and today's valuations. Most can't refinance, many won't try, which means defaults stop being hypothetical and start becoming synchronized. So the Charlotte filing isn't the event, it's the preview, a glimpse of what happens when hidden losses meet a deadline. And once those deadlines start hitting across hundreds of banks at the same time, the system doesn't get to choose how to respond. Because the next layer of this story isn't about balance sheets, it's about pressure. And pressure is what turns stress into failure. Here's the first hard proof that this isn't speculative. Fact. The content states that commercial real estate losses are already locking in, not waiting on the future. Office loan delinquency rates held by banks jumped from 0.4% in January 2023 to 4.8% by December 2025. That's not a rounding error. That's an 11-fold increase. And delinquency isn't an early warning. It's what shows up after months of missed payments, after negotiations fail, after the borrower is already out of options. Now zoom in on what that actually means inside a bank. When an office building stops paying, the bank doesn't get a temporary markdown like it does with a bond. Fact, the content walks through the chain. Default, foreclosure, forced sale, often at 40 cents on the dollar. That loss hits capital immediately. No accounting delay, no held-to-maturity fiction, capital erased in real time. This is the kind of loss regulators can't ignore. Notice what's missing from public conversation right now. You hear about office vacancies, you hear about remote work. What you don't hear is how concentrated this risk is. Fact, of the $3 trillion in commercial real estate loans held by U.S. banks, $626 billion are office loans. And according to the cited analysis, 44% of those are already in negative equity, nearly half. That's $275 billion in office loans where the building is worth less than the debt. This is where the math turns hostile. A bond can recover with time. A half-empty office tower cannot. Tenants don't magically come back. Rents don't snap higher. And when a bank takes ownership of a building nobody wants, it doesn't just lose money, it loses time, flexibility, and credibility. Now watch how fast this escalates. Fact, when you add retail properties, older malls and strip centers, with national vacancy rates at 14.2%, and then layer in multifamily properties facing stalled rent growth and rising delinquencies, the content calculates $421 billion in commercial real estate losses already forming, already visible, already measurable. This is the moment the story changes shape. Because at this scale, losses don't stay isolated. They force behavior, and behavior is what turns bad numbers into systemic failure. The next part is where pressure turns into acceleration and why this doesn't unwind slowly. Now comes the contradiction that makes this far more dangerous than it looks. Fact, even after accounting for roughly $421 billion in commercial real estate losses, banks are still carrying another $620 billion in unrealized losses on securities as of September 30th, 2025. Those are the bonds bought when rates were near zero, now worth 20 to 30% less. On their own, that's survivable if nothing else goes wrong. But here's the part that permanently changes how you should see this. These two loss pools don't exist separately, they collide. When commercial real estate defaults force banks to absorb permanent losses, capital shrinks. And when capital shrinks, banks lose the ability to sit patiently on those securities losses. They need cash, which means selling assets, which means turning unrealized into real. This is where words and actions split apart. Publicly, banks say they're well capitalized. Fact. Privately, the content shows many are one forced sale away from revealing losses that wipe out what capital they have left. That's exactly what happened in March 2023. Silicon Valley Bank didn't fail because the bonds were bad. It failed because depositors moved, forcing sales, forcing losses, forcing collapse. Notice what's different now. In 2023, securities losses were the trigger. Today, commercial real estate is the weight, and it's heavier. Fact. Between March and December of 2026, $936 billion in commercial real estate loans are scheduled to mature. That's not spread over years, that's 11 months, and these aren't amortizing loans, they're balloons. Refinance or default. Now watch how quickly the options disappear. Fact. Properties are appraising 20 to 40% below 2021 values. To refinance, borrowers have to bring cash to cover the gap. Most don't have it, which leaves the third option, hand the keys back. Strategic default. When that happens, the loss is immediate and the capital hit is unavoidable. Industry estimates in the content put default rates between 25 and 35%. Use 30% and you're looking at $281 billion in new losses from maturities alone. Add that to what's already visible, and the system is staring at roughly $1.3 trillion in banking losses before panic even enters the room. And here's the dangerous quiet detail. None of this requires a recession to start. This is all mechanical, calendar-driven, math-driven, which means the system doesn't get to vote on whether it happens, because once these losses surface, the next force takes over, and that force doesn't care about balance sheets. It cares about fear. This is where contagion stops being a theory and starts behaving like physics. Fact. When Silicon Valley Bank failed in March 2023, it didn't collapse in isolation. 2 days later, Signature Bank followed. Then First Republic unraveled after losing $100 billion in deposits in just 48 hours. Not because its loans were bad, but because depositors didn't wait to find out. Fear moved faster than facts. Now notice why 2026 is more dangerous than 2023. Back then, commercial real estate hadn't cracked yet. Losses were mostly hidden in bond portfolios. Today, the damage is visible. Office towers selling for half their old price, malls being torn down, apartment buildings with rising vacancies. Fact. The content makes clear these aren't rumors anymore. They're transactions, they're court filings, they're headlines waiting to stack. Here's the attention reset. Contagion doesn't start when a bank fails. It starts when people imagine one might. And once that question enters the system, is my bank next? Answers don't calm anyone. Movement does. Deposits don't argue. They leave. Fact. According to the FDIC, there are 1,788 federally insured banks with commercial real estate exposure exceeding 300% of their total equity capital. That's the regulatory line for high risk. Over 1,000 of those exceed 400%, more than 500 exceed 500%. These banks don't have a margin of error. They have a countdown. So picture the sequence. A few regional banks fail over a single weekend. Regulators step in quietly. Depositors are told everything is fine, and on Monday morning, money starts moving. Not slowly, not emotionally, automatically, from regional banks to the biggest institutions with implicit government backing. That movement forces asset sales. Asset sales force loss recognition. Losses trigger more fear. More fear triggers more withdrawals. This is the doom loop, and once it starts, no press conference can reverse it. The most unsettling part is how ordinary this looks from the outside. ATMs still work, apps still open, until suddenly they don't. And by the time the failure becomes obvious, the outcome is already locked. Because the next question isn't whether banks fail. It's whether the system designed to catch them can survive the fall. Now shift the camera off the balance sheets and onto where this actually lands, because this doesn't stay inside banks. It leaks into normal life fast. Fact, when banks fail or are seized, operations don't freeze forever, but they do glitch. Cards stop working, online banking goes dark, payroll gets delayed, and those delays don't hit investors. They hit people who were expecting money to clear on a specific day. Picture a small business running payroll on a Thursday. The bank gets seized Friday night. The FDIC says deposits are protected, but systems don't reopen cleanly until Monday. That's 3 days of employees not getting paid. Rent doesn't wait, groceries don't wait, life doesn't wait. This is how a financial issue turns into a human one without warning. And it doesn't stop there. Fact. The content shows that when regional banks pull back, commercial real estate lending freezes, construction halts, developers can't refinance, contractors don't get new projects, workers get laid off. That's not ideology, that's mechanics. Credit is oxygen. When it disappears, things suffocate quietly at first, then all at once. Here's the part that feels familiar to more people than they expect. When credit tightens, everything becomes conditional. Loans that were approved get rechecked, lines of credit shrink. Renewals come with new terms. Businesses that were healthy 6 months ago suddenly don't qualify, not because they failed, but because the bank did. And even if your money is insured, access still matters. Fact, the content explains that FDIC protection doesn't mean instant availability. During failures, there can be delays. Short ones, but real ones. If you rely on timing, paychecks, rent, automatic payments, those gaps create stress fast. If this feels uncomfortably close to home, say so in the comments. Not because panic helps, but because patterns repeat whether people acknowledge them or not. Because once enough people feel this pressure at the same time, the story stops being about individual banks. It becomes about the system that allowed this exposure to build in plain sight. Here's the unsettling insight that ties all of this together. This didn't happen because banks missed the risk. It happened because the system rewarded them for ignoring it. Fact, for years, low interest rates made leverage look safe. Commercial real estate loans produced steady income. Securities portfolios looked conservative. Regulators focused on liquidity, not valuation. As long as nothing was sold, nothing was wrong. That incentive structure matters. Banks weren't optimizing for resilience. They were optimizing for yield under rules that treated time as a solution. If you can hold long enough, losses disappear. Except time stopped helping the moment rates reset and demand changed permanently. Remote work didn't pause. E-commerce didn't reverse. Higher financing costs didn't blink. Here's where the mechanism becomes clear. Once losses are hidden, risk concentrates. Once risk concentrates, fear becomes rational. And once fear becomes rational, behavior shifts faster than policy. Regulators can close banks, central banks can lend, but they cannot make borrowers refinance loans that don't pencil. And they cannot make depositors sit still when an app lets them move millions in seconds. This is why the spectacle matters. Every seizure, every emergency facility, everything is fine press conference does two things at once. It stabilizes the system temporarily, and it teaches people what to watch for next time. That learning effect makes each cycle faster than the last. The calm but dangerous truth is this: the system isn't breaking because people are panicking. People are panicking because the system's design makes panic logical once certain thresholds are crossed. And by the time those thresholds are visible, the leverage is already baked in. That's why this moment feels different from normal downturns. There's no single villain, no single shock, just incentives, deadlines, and arithmetic lining up at the same time. And when that happens, outcomes stop being negotiated. They unfold. Which brings us to the part everyone is watching, but few are modeling correctly. What happens next isn't one path, it's two. And the choice isn't made by voters or headlines, it's made by momentum. From here, the system splits into two possible trajectories, and neither is clean. Fact. The content makes clear that losses are already measurable, deadlines are fixed, and capital is finite. What changes now is how aggressively authorities step in and how quickly confidence erodes before they do. Path one looks controlled on the surface. Regulators move fast. Banks are merged quietly over weekends. Emergency facilities are rolled out with neutral names. The Federal Reserve provides liquidity. The Treasury backstops the FDIC. On paper, the system holds. But notice the trade-off. Credit tightens sharply. Lending slows. Banks that survive become defensive. They hoard capital. They stop taking risk. This is how a crisis avoids collapse but slips into stagnation. Path two moves faster and feels uglier. A cluster of bank failures hits before those backstops are fully trusted. Depositors move first, markets react second, policy follows third. Fact. The content shows how quickly deposit flight can overwhelm even solvent institutions once fear sets in. In this path, losses are forced into the open all at once. Mergers become fire sales. Confidence breaks before coordination catches up. Here's the attention reset. Neither path prevents pain. They only change its shape. One spreads it over years. The other compresses it into months, and the system doesn't get to pause and choose calmly. It reacts to pressure in real time. What's already forming is the next move. Watch the calendar, watch maturities, watch which banks stop lending first. Those are early signals of which path is taking control, because by the time headlines announce a direction, capital has already repositioned. The most important thing to understand is this: outcomes aren't decided by one announcement or one failure. They're decided by sequences, and sequences are already in motion. Here's the insight that pulls the whole story into focus. The collapse didn't start when banks began failing. It started when losses became socially acceptable to ignore. Fact. The content shows years of unrealized losses, regulatory tolerance, and incentives built around delay. The Charlotte filing didn't create the problem. It revealed that time had finally run out. Reframe the story in one sentence. This isn't a sudden crisis. It's a slow structural failure that only looks sudden when it crosses a deadline. And deadlines don't negotiate. They arrive whether anyone is ready or not. That's why the $8.5 trillion number matters. Not because it's dramatic, but because it's cumulative. Banking losses, bailouts, investor write-downs, recession damage. Fact, when those layers stack, the cost isn't absorbed by one sector. It spreads across wages, savings, credit access, and time. Years of it. And this is where the loop closes. The most dangerous phase of any financial collapse is the moment just before it becomes obvious. When institutions are still open, when reassurances are still issued, when people assume they'll have time to react. The content is clear about this part. By the time panic is visible, the mechanical damage is already locked in. The quiet truth is that nothing dramatic has to happen next for consequences to unfold. The calendar alone does the work. Maturing loans, capital ratios, deposit sensitivity, these are slow gears that don't stop once they start turning. So the question isn't whether this affects you, it's when you're forced to notice it and whether you understand what you're seeing before everyone else does. That's why this channel exists. Not for headlines, not for panic, but for pattern recognition before the noise overwhelms the signal. Because this story doesn't end here. It evolves, and the next layer is already forming.